Okay. Okay, I'm going to give participants a few seconds to trickle in, and then we can get started. Sebastian, in the meantime, you can go ahead and share your screen if you want to.
All right.
Okay, well, welcome everyone to this session on fiscal sustainability in low rate environments, which is hosted by the Society for Economic Dynamics. And let me start by thanking Larry Cristiano for giving us the opportunity to organize this session on fiscal sustainability. Obviously a topical question. We're going to start with the fiscal theory of the price level with a bubble, and Sebastian is going to be presenting, Sebastian Merkel. Sebastian, you have the floor.
All right. Then thank you, Hanno, for the introduction, and thanks also for having our paper on the program. So yeah, I'm presenting the fiscal theory of the price level with a bubble, or short the FTPL with a bubble. That's joint work with Markus from Princeton and Yuliy from Stanford. So different monetary theories emphasize different roles of money and different equilibrium equations to pin down the price level. And the FTPL emphasizes the role of broad money, meaning including nominal government bonds as a store of value. And its key equation is that the real value of all bonds must be equal to the present discounted value of future primary surpluses, which is taxes in excess of government spending. And we discount by the market SDF, whatever that is. So by Xi, we mean the stochastic discount factor of the marginal agent in the market for government bonds. Now, critics of the FTPL have pointed to Japan. Japan has run primary deficits since the 60s, with one small exception in here. So if the past is any guide for the future, then likely Japanese primary surpluses are also negative in the future, meaning the present value of all future primary surpluses will also be negative. At the same time, Japan hasn't had any trouble accumulating a large amount of public debt, so that appears to be somewhat inconsistent with that equation. Now, even worse for the FTPL, the mechanism that the FTPL emphasizes to bring such unsustainable fiscal policy in line with reality is inflation. Yet for Japan, we haven't seen any inflation for a very long time. So it looks like the FTPL is very hard to reconcile with that Japanese example. Now, in this paper, we propose a rather simple explanation how we can resolve this Japan critique of the FTPL, namely this equation that I've put on this slide is missing a term. In particular, we think about in low interest rate environments that there can be a bubble on government debt. And potentially, if government debt has a bubble, then countries like Japan may have a sustainable debt, even though they run deficits. Now, before I go into what we do in the paper, let me make two remarks. The first is, in a sense, this issue is at a fundamental level broader than the FTPL, because this equation here holds in all our models. The only thing is that in most conventional models, it's interpreted differently as a constraint on the government. So then simply we would conclude that negative surplus policy is inadmissible. So it's just not possible to do that. So the broader question in a sense is, can a country run primary deficits forever? And if so, under which circumstances can it do so? Why do we choose the FTPL framing? Mainly because the FTPL interprets this as an asset pricing equation, and it at least allows the government to attempt a policy that uses deficits. And once we add a bubble on top of it, then interpreting that thing as a budget constraint is kind of tricky, because government policy affects whether there is a bubble and how big the bubble is. So it's not entirely clear what constraint this equation then actually imposes. So in a sense, the FTPL makes it easier to think about this equation in such an environment. The second remark I want to make is that even without a bubble, this traditional pricing equation of government debt can make sense of negative surpluses or positive deficits if we allow for a component of government debt, let's call it M, to provide a special role in transactions. I think Ludwig is going to present a model of that style later on. If that's the case, then there's a second term, even in a conventional equation, that says that has some present value of future convenience yields associated with this M component of government debt in it. And that allows for some seniorage revenues and potentially some deficits. The bubble is very similar to that, but there is an important difference, and I would like to point that out. Assets with a bubble are still consistent with arbitrage-free asset pricing, which means if we have another asset, such as a safe corporate bond, that has the same risk characteristics as government debt, then it must have the same return. So we won't see a spread between the two. And therefore, if we look at empirically measured convenience yields, we won't see the benefit that a bubble gives the government. We simply can't, theoretically, because there won't be that spread. So now with these remarks, let me go into our paper. And let's first think about why can there be a bubble? Why may there be a missing term? And to do that, let's just revisit the derivation of this key equation of the FTPL. So that derivation starts from the nominal flow budget constraint of the government. I will be working here in continuous time. That budget constraint simply says that the sources of nominal funds must equal nominal expenditures of the government. Now, what are the sources of funds? It's tax revenues, and divided by the price level makes it nominal. So this is real tax revenues. And it's bond issuance, which consists of the growth rate of outstanding nominal bonds times the face value of outstanding nominal bonds. And then the expenditures of the government are interest payments on outstanding bonds, and it's government expenditures, so the price level times the real expenditures. Now we simply multiply that budget constraint by the nominal SDF, which is a real SDF divided by the price level, integrate that thing forward from time t to some terminal time capital T, take expectations and the limit to t to infinity. Probably all of you have seen such a derivation. And then what we get is that the value of all government debt is equal to the present value of primary surpluses, discounted by this market SDF that prices the bonds, plus a limit of some terminal term, some discounted terminal value of bonds. And now the literature usually proceeds in invoking a private sector transversality condition to conclude that this second term is zero. What we want to do in this paper is look at environments where that argument fails, and therefore a bubble emerges that increases the value of debt beyond the present value of the primary surpluses. So when can such a bubble exist? To make things simple, let's suppose we have a stationary debt to GDP ratio, and let's suppose there's no aggregate risk. In that special case, the value of government debt must grow at a GDP growth rate, at a constant GDP growth rate. And because it's risk-free, the stochastic discount factor, at least the relevant dimension for government debt risk, will simply decay at a risk-free rate. So if we look at the product of those two in this terminal value condition, well, then it has a decay rate of the risk-free rate minus the growth rate. And if that's larger than zero, because the risk-free rate is larger than the growth rate, then it goes to zero and there can't be a bubble. But if that inequality is not satisfied because the risk-free rate is smaller or equal than zero, then a bubble can exist. And more generally, we would have to replace the risk-free rate in that comparison with the appropriate risk-adjusted rate that's implied by the SDF on the risk in this real value of debt. So if here in this case, it would be, for example, GDP risk. But we will stay in the environment without aggregate risk. We will make even another simplification. Let's suppose there's log utility. Agents have log utility. And let's suppose we're on a balanced growth path. The first feature, log utility, means that a risk-free rate is equal to the time preference rate of agents plus individual consumption growth, expected consumption growth, minus the variance of individual consumption growth. There may be no aggregate risk, but potentially there's idiosyncratic risk that generates such a variance. And balanced growth means that the growth rate of the economy must be equal to the growth rate of aggregate consumption. Now, looking at these equations, we see two cases in which potentially the risk-free rate is smaller than the growth rate. And in our paper, we make two examples with two models that cover these two cases. So the first is a perpetual youth example where there is population growth. And then it can be that the individual consumption growth is smaller than the aggregate consumption growth because the aggregate grows, the number of people grow. And if that difference is large enough, even if there's no risk, the risk-free rate can be smaller than the growth rate. The second example has the same growth rate of individual and aggregate consumption growth, a constant population, but there's uninsurable idiosyncratic risk, so that this precautionary term depresses the risk-free rate below the growth rate. And then again, there can be a bubble. So with that introduction, let me go into the two models. Let me explain some of the details in the models, and then let's let's see why the transversality condition in these models doesn't rule out bubble existence, even though agents are long-lived. And after that, I would talk about how the bubble represents a fiscal resource that the government potentially can mine for expenditures. In the paper, we also talk about core FTPL issues like price level determination, but for this session, this seems a bit less relevant, so I won't talk about this today. So let's start with the perpetual youth model. So it's the following setup. It's a continuous time model with an infinite horizon. There's one consumption good. There's a growing continuum of agents, and we make them infinitely lived. So we abstract from death. If you look at Blanchard's initial paper, there was death inside there, and that makes everything a bit more complicated. We don't need that. We abstract from that. So each of these guys is endowed with 1 unit of human capital at birth, and that is going to depreciate over time. And that means that these agents want to save, and the only savings instruments they have in this economy is a traded government bond. That bond is issued by the government that has some exogenous spending need, that taxes output from human capital, and that issues these bonds, and these bonds are nominal so that we can do a bit of FTPL. And there's one friction, one standard OLG type friction. There's no trade with yet unborn generations. But that's not too important in the end because this friction is going to be alleviated by the bonds. Let me give you some formal details because I use notation later on. So let's denote population by capital L that grows at a fixed rate G. And the set of agents is denoted by this interval from 0 to capital L, and that grows over time. Each agent has standard logarithmic preferences with time preference rate rho and logarithmic preferences over consumption. Each agent has human capital, which we denote by K because it nicely, then we have the same notation with the second model where there's physical capital. At the birth of that agent, T0I, that agent has exactly 1 unit of human capital. And then over time, human capital depreciates at a constant depreciation rate. We could put that to 0, but we leave it partially positive in the paper. So human capital produces output simply according to some linear production function. So if you have double as much human capital, you produce double as much output. That's your income, that's your pre-tax income. But then the government comes and taxes your human capital income at a constant tax rate tau. So your after-tax income is simply 1 minus tau times your production. And within this simple setting, the real bond holdings of the individual agents, so BIT is the real value of their bond holdings, satisfies this accumulation equation or budget constraint. Your bond holdings grow at a risk-free rate because bonds are risk-free. And then you have some after-tax income from human capital and you consume. So this is your savings and that adds to your bond holdings or subtract from it if consumption is larger than your production. Then there's a government budget constraint, and that's similar to the one I showed you before. So interest payments by the government are equal to the nominal primary surplus, which is the price level times the real primary surplus. And here we denote this tau A minus G, the surplus per unit of capital by little s. And then there's bond issuance. You grow the bonds at a certain rate times the number of bonds you already have. So that's the model. It's a very simple perpetual youth model. Now there's a second model. And let me just tell you what's different in a second model and then why I even tell you about that second model at all. So in that second model, there's a fixed continuum of agents. Instead of human capital, they have physical capital that they can trade. And that physical capital is subject to, that produces something again according to some linear production function as in the other model, but it's subject to idiosyncratic risks. So your machines sometimes break down or sometimes they become more productive. So that you kind of face these idiosyncratic capital shocks. And the other difference to the perpetual youth model is you can physically reinvest into that capital stock. And that makes a growth rate endogenous. And then these people can trade capital and bonds, whereas before they had to hold on to their human capital and just could trade bonds. The friction here is that they cannot trade idiosyncratic risk. So they have to be exposed to the idiosyncratic risk inherent in their capital operation. So why do we need such a second example at all? So I think there are some reasons why this is interesting to look at that in addition to the perpetual youth. The first is this model has and capital asset and a return on capital that's larger than the growth rate. And that connects somewhat to the literature, to Blanchard's paper and to the paper that Ricardo is going to present, whereas the other model, the perpetual youth model, doesn't have capital at all and no asset has a higher return than the growth rate. The second thing is that the growth rate here is endogenous and that it's affected by government policy, and that matters somewhat for later on when we think about how inflationary are certain government policies. And it also matters for welfare. And in addition, markets here are incomplete, even exposed, even when there is a bubble that partially completes the market, and that leads to richer welfare implications. So that's the reason why we think that second model is interesting and adds to the first. Nevertheless, they are very similar, and therefore I treat them in parallel from now on. So here's one graph that plots the growth rate and the risk-free rate in the monetary steady state of these models. So these are models with bubbles, they have multiple equilibria, but you can show there's only one steady state equilibrium in which government bonds have positive value in each of those models. And I plot the growth rate and the risk-free rate against the key policy variable, which is how much the government grows its nominal debt in excess of the nominal interest rate. That's a measure of how much do you dilute the claim of the existing bondholders by growing your debt at a faster rate than you compensate them for by paying them interest rates. So this mu check B is a rate of bond dilution. Through the government budget constraint, this is also related to the surplus, to the primary deficit of the government. So if it's positive, it's proportional to the primary deficit. So in a sense, when this is negative, the government runs primary surpluses, and the risk-free rate is endogenously larger than the growth rate in both models. Whereas when this is positive, then the government dilutes the bond stock and runs primary deficits, and the risk-free rate is endogenously smaller than the growth rate. And it can be because a bubble emerges in these regions where this bond dilution rate is positive. Now, the main difference here between the two models is that growth rate in the perpetual youth model is constant, it's simply population growth, whereas in the idiosyncratic risk model, it's increasing in bond dilution. The reason is that as the bond stock gets diluted at a faster rate, agents reallocate their portfolios into capital that leads to fiscal reinvestment, and that increases the growth rate. So now, why do the transversality conditions in this model not rule out bubbles? So we have long-lived agents. So each guy I has a transversality condition of the form my discounted value of future bond wealth is equal to 0. So why doesn't that rule out a bubble? The reason is that in the transversality conditions, we look at individual bond wealth, individual real bond wealth. Whereas in the bubble, we look at the aggregate real bond wealth, discounted at the same SDF. So to the extent that the aggregate value of the total bond wealth differs from the individual bond wealth, the transversality condition can hold, yet this second limit converges to something positive, not to 0. So why would that be the case? Individual portfolios and aggregate portfolios could differ because they are beneficial equilibrium traits, and that happens in both of these models. So in the perpetual youth model, bonds allow intergeneration resource transfers, meaning individuals pass on the bonds to newborn generations so that the bonds get distributed over more and more people, and therefore individual bond wealth grows at a smaller rate than aggregate bond wealth. And that means that here in this transversality condition, we discount something that decays, whereas here we discount something that doesn't decay, or at least here it decays less than here. So it's completely consistent that this goes to 0 and this goes to something positive. In the idiosyncratic risk model, bonds are a safe asset. They allow for self-insurance. And how does that work? By agents trading bonds to rebalance their portfolios in response to their own idiosyncratic shocks. But that means that their own bond wealth, BTI, is stochastic, whereas the aggregate bond wealth remains deterministic because shocks cancel out. And that means if you look at this term here, SDF times bond wealth, that's stochastic, then there's going to be a risk premium involved in the effective discount rate, so that agents discount their own bond wealth as a higher rate than the aggregate bond wealth. And then again, the transversality condition can hold, yet there can be a bubble. So here's something that I skip in the interest of time. It relates to another paper of ours. Let me instead go immediately into how can the bubble be a fiscal resource. And for that, let me remind you, the primary surplus in this model is S times the capital stock, human or physical, depending on the model, and S is simply tax collections from the output tax minus the exogenous government spending need. If we put the initial capital stock to 1, then we can write the government debt valuation equation simply as that the value of government debt is equal to the limit as the horizon goes to infinity of the present value of this surplus capital ratio plus some terminal term. Why the surplus capital ratio? Because the surplus is S times K, but K grows at a constant rate Xi. So I've taken that out and put that here in the discount rate, and then we discount at risk-free rate minus growth rate. The terminal term the same, the value of debt grows at a constant rate Xi. I've taken that out and put it in discount rate, and we discount at risk-free rate minus growth rate. The risk-free rate in this example we can show in both models is equal to Xi minus this bond dilution rate. And then we get three cases. So if we plot here the bond dilution rate and think about what happens in this model, well, if the bond dilution rate is negative through the government budget constraint, the surpluses are positive. Through this equation, the risk-free rate is above the growth rate, and thus the present value of surplus is going to converge and is positive, and this term here is going to converge to zero, so there's no bubble. If the bond dilution rate is zero, then through this equation, the risk-free rate is going to be exactly equal to the growth rate. Through the government budget constraint, surpluses are zero, so the present value of surpluses is zero, and here in the bubble there's no discounting, so that the bubble is exactly equal to the value of debt. Now, if the bond dilution rate turns positive, surpluses turn negative, the risk-free rate goes below the growth rate, then the present value of surpluses goes negative, the bubble goes positive. Effectively, actually, the present value of surplus becomes minus infinity and the bubble becomes plus infinity, but only the limit of the sum in a sense matters for this equation. So there is no inconsistency here. So this last case, where there are primary deficits forever, that is what we call bubble mining, because in a sense, the government funds its deficits out of the bubble without ever raising taxes. So this is simply a Ponzi scheme. So that's how we think about bubble mining. Now, even if the government doesn't outright mine the bubble, nevertheless, the possibility of a bubble gives the government additional leeway and makes that more sustainable. In the following sense, if surpluses are precisely zero, then government debt still has a positive value despite zero surpluses. So in a sense, the debt is fully backed just by the bubble. If surpluses are positive, then there is no equilibrium bubble. Yet, having an environment where there could be a bubble, if surpluses drop negative, is beneficial and makes that more sustainable. Suppose we have some shock that turns surpluses, say, unexpectedly negative very persistently, then instead of the value of debt collapsing, simply a bubble would emerge and stabilize the value of debt. Now, if we can mine the bubble, and if this bubble even becomes infinite, does that mean there is no constraint anymore on the government? And the answer is no. And we see the answer is simply that this debt valuation equation is not a good way of thinking about a constraint on the government. Instead, we have to think about what actually determines the value of debt if there is a bubble. And the answer is a wealth effect on the value of debt that generates in the goods market. So when the value of debt is larger, then there's more wealth effect on government debt and therefore more consumption demand. But goods are finite, so at some point, the goods market doesn't clear. And then we can see the following. The primary deficit is equal through the government budget constraint, through this rate of bond dilution or bubble mining, times the value of the bonds. But if we increase the rate of bond dilution, let's take the perpetual youth model, we lower the nominal interest rate because bonds become worse as a savings device. That increases the present value of my labor income and therefore the consumption demand coming from the wealth effect from that component of my wealth. And then there's less output left that can be taken from the wealth effect on the bubble or on the government debt, so that the value of the government debt has to go down or the price level has to go up for the goods market to clear. So in a sense, by increasing this bond dilution or bubble mining rate, we reduce our tax base, our value of bonds. And therefore, a Laffer curve type of intuition emerges, where as I increase bubble mining, initially I generate larger primary deficits, but eventually the erosion of the tax base becomes more important, and then the deficit that I can get out of bubble mining goes down. So that generates a Laffer curve. Now there are two more questions I want to get at, and because I see I'm almost out of time, let me mainly...
You've got 2 more minutes, Sebastian.
Okay, so let me mainly skip this one and just give you the takeaway. So one question is bubble mining inflationary? And the answer is it depends. It depends on how you do it. So if you grow your debt and leave the nominal interest constant, and there is no feedback on growth, then it's inflationary. However, in our second model with idiosyncratic risk, there is a feedback on growth that dampens the inflation effect. And second, if your nominal interest rate is unconstrained, you can also raise bubble mining by lowering the nominal rate. And so in a sense, it is possible under certain circumstances to increase bubble mining without increasing inflation. So while that sounds a bit like an MMT type message, the second question that is interesting is, should we, from a normative perspective, use bubble mining to fund the government? And here the answer is largely negative. So we do here two things. First, we ask for a Ramsey planner who controls the tax rate and the bubble mining rate. Would that Ramsey planner ever choose a positive bubble mining rate? And the answer in the perpetual youth model is always negative. And I'll skip why it's negative. In the idiosyncratic risk model, which is a bit more interesting, the answer is it can be, the rate of bubble mining, the optimal rate of bubble mining can be positive if idiosyncratic risk is large enough. And the reason here is that a bubble has generates a trade-off between risk sharing. More bubble is good for risk sharing, but crowds out growth enhancing capital investments, whereas less of the bubble is worse for risk sharing, but you get more capital investments and thus larger growth. And because markets are incomplete, there are pecuniary externalities. And here it turns out that for large idiosyncratic risk, they go in the direction that the bubble is too large. And therefore, we want to shrink it to make the allocation constraint efficient. But importantly, that reasoning has nothing to do with how much funds the government wants. This has just to do with correcting some pricing in the market. And that's a second important takeaway that holds in both models. The optimal rate of bubble mining is independent of the need of the government for spending. So we shouldn't raise bubble mining to increase government expenditures, but the marginal funding source for the government for a Ramsey planner is always the tax rate, not the bubble mining rate. Okay, so in the interest of time, I will conclude here. So what we do in this paper, we integrate the missing bubble term into the FTPL equation, but ultimately this is really also about debt sustainability. We provide two models where the risk-free rate is below the growth rate, and we have bubbles, perpetual youth and idiosyncratic risk. In both models, the transversality condition does not rule out the bubbles because transversality is about individual bond portfolios, while a bubble is about the aggregate bond wealth, and those two are not the same. And the government can mine the bubble for revenue, which is a form of seigniorage, and it may not even be inflationary. Nevertheless, it may also not be socially optimal. And mining for the sole purpose of just raising revenue is actually never optimal. All right, then thanks.
Okay, thanks, Sebastian. I've left a few minutes for questions. So if anybody has a question, you can use the Q&A feature or raise your hand, and I can call on you. If not, I have a quick sort of clarifying question. So in the model with idiosyncratic risk, is the key difference between your model and say an Ayagari model that if you accumulate capital in your model, you're subject to idiosyncratic risk, whereas if you accumulate government bonds, that's not the case. Is that the key difference? Whereas in an Ayagari model, that wouldn't be true.
Exactly.
Right?
So in the typical Ayagari model or the standard Ayagari model, capital is free of idiosyncratic risk, and then you can show there can't be a bubble with a normal production function that always has a positive marginal product of capital. So that is true. Here we have idiosyncratic risk on the capital, so idiosyncratic return risk, and therefore the government provides some safety that capital never can provide. So this is important, yes.
Right. And so there's no other asset that you can accumulate that is not subject to idiosyncratic risk other than government bonds. That's kind of the key. And that's what
correct in this model. Though I would like to point out, so we have this other paper, Markus, Yuliy, and I, it's called Debt as Safe Asset. And in that paper, we had aggregate risk and we had a stock market. Mm-hmm. And a stock also allow you to diversify idiosyncratic risk. So there is another asset in that model. However, in that model, endogenously, stock dividends go down in recessions when idiosyncratic risk goes up. And the reason for that is that there are always insiders in companies that have to bear the idiosyncratic risk, and those have to be exposed. And then the stock inherits, in a sense, the properties of this idiosyncratically risky capital. So you can relax that somewhat, but you need to link the value of, say, other assets that are less safe than government bonds somehow to the idiosyncratic risk in the economy, or restrict holdings, in other words.
Thank you. Thanks for clarifying. Okay, great. All right. So unless there are any other questions, we're going to move on to the next paper on the program. So thanks, Sebastian.
Thanks, Tim.
The next paper is going to be presented by Ricardo Reis, and Ricardo is presenting the constraint on public debt when R is lower than G, but G is lower than M. So Ricardo, you can go ahead and share the screen. Oh, I see that you've already done that. Looks good. All right, take it away.
Okay, great. So thanks for having me in this panel of lots of people trying to attack this problem from different angles of trying to make sense of this world with R less than G, or as the title of the session says, when R seems to be low for a period of time. So the main focus of this paper is going to be to try to make sense of whether we have well-defined budget constraints when R is less than G. But at the same time, even though the interest on government debt is less than the growth of the economy, that growth of the economy is below the marginal part of capital, M, such that you at the same time can have the world that Olivier Blanchard emphasized in his presidential address and the world that Thomas Piketty emphasized in his best-selling book, which was also about R and G, but to distinguish it, I'm going to call Piketty's R is M. So it's really a paper about two Frenchmen and what it implies for the public debt. Now, on that, let me right away jump into some notation, make a general point that's shared across the papers, and then show you my model of it. It is an accounting identity that the total deficit, the change in the debt B, is equal to the primary deficit, which I'm going to call S for net spending, plus the return to the bondholders. Right away, in this paper, I'm going to take the primary deficit as exogenous. What I want to ask is, what is the limit on how high B can go before this equation no longer holds? Or if you want, conversely, how high can this exogenous S be while respecting a borrowing constraint, the borrowing budget constraint, I'm sorry. Second point, little b is an endogenous object in this model. So this is not the face value of that B, but the market value of the debt. And so this V is actually going to be a very important jump variable in the model. And that means, therefore, that the return to the bondholders, it is not just some promised coupon, but also some capital gain that you could earn on the bonds. And finally, thirdly, I am going to restrict myself to balanced growth paths in which asymptotically the debt is going to grow at the rate of GDP. So we neither end up with debt going to zero nor debt going to infinity as share of GDP, which would either make the problem somewhat either uninteresting or start violating some market clearing conditions. Starting from this debt dynamic equation and with these simplifications, reductions of the problem that I just discussed, note that starting from the differential equation, if you just pick a sequence dt of discount rates that satisfies the probability that at the limit, those discount rates are bigger than the growth of the economy, then it is a mathematical equivalent. So you can write this differential equation in integral form, which says that the debt is equal to this term on the surpluses plus, or on the spending, I'm sorry, plus this other term. This is true for any sequence D. However, which D will you use is where the economic content comes, and the conventional analysis of debt sustainability has used R. This today is no longer possible because R does not satisfy this condition. The proposal in this paper is let's use M, the marginal part of capital. That M satisfies this condition empirically. Many different ways to measure the marginal part of capital, but it seems to be well above the growth rate of the economy. And so right away, it's a legitimate. Moreover, it's not only legitimate, meaning it's possible, but also there are some good arguments for why you may want to use M as a D, in which case you end up with this integral version of the budget constraint. One argument is that the marginal part of capital, insofar as capital is the alternative to government bonds, is going to be what the representative agent in a macro sense will hold as an alternative to the government debt, and therefore what it will use to discount the future spendings and other terms that are there. Moreover, note that M bigger than G is a dynamic efficiency condition that will hold in many economies. Importantly, what that shows is that not only we have a present value of surpluses, but we have a second term, much like Sebastian just emphasized. And this second term, as I recently reviewed in a survey, is very general across many other papers. And it is a term that has received many names. The bubble term in Markus's paper, given in Sebastian's paper, given what he presented. In other places, it's called the seniors term, the convenience term. I try to say, let's call it the debt revenue term. Why? Because it says that given an amount of debt, this is a flow of revenue that you get from the fact that that debt pays an interest rate that's lower than the alternative. And so I tried that revenue term because I thought it was a little broader, and so that people understand that it's combines many different ones there. And why does it combine many different ones? Because whenever you're going to have that the D, i.e. the M, is it arises because the marginal part of capital relative to the bonds have different risk profiles, collateral abilities, liquidity, financial regulation applying differently, seniorage, bubble, any specialness leads to there being a term like this. Also, by the way, this holds if there's aggregate uncertainty. I'm going to abstract from aggregate uncertainty throughout the entire presentation, since that's been covered in other papers, I think, well. And there's a rich literature exploring the implications of this and measuring it in different ways. This paper, what I will do is, with keeping very much in mind how this, thinking about this term is going to be useful, is to write a model for why M is bigger than G than R, and then think about how changes that exogenous S spending affect the equilibrium N minus R and B. Because just as Sebastian noted, there is in principle, this term can have a Laffer curve element in that as one changes S in my case, B is going to change, but M minus R may well change in the opposite direction. And therefore there may be a Laffer, or at least a bounded point to that. And I'm going to exactly look at what is the largest spending such that that is positive value in equilibrium. That's what the paper is going to do and how this debt revenue is going to use it. In terms of very quickly, I'm going to use a model that's based on these kind of papers of misallocation for the most part. And there are other trade-offs in the literature that a bunch of different papers, including Ludwig's paper, that's going to think about different sets of trade-offs still from that perspective. And there's also a very rich literature in the last few months on welfare, which I'm not going to be focusing on, just focusing on the capacity. So with that in mind, here is the model. There's going to be, if you start with no heterogeneity, this would be a conventional AK model. There's some capital, you earn some, instead of A, I'm going to call it M, the marginal part of capital. A firm would rent capital at R for it. However, there's going to be heterogeneity. In particular, starting with a simpler case with two types, there's going to be some guys who have a high quality of capital, 1. As a result, they earn the whole M. But then there's some other guys, a share of which is 1 minus alpha, for whom the individual quality of their capital is 0. This is ex ante, so this is not about idiosyncratic risk. It's about the fact that there's simply heterogeneity. Now we alternate among these types, and indeed we can generalize from the two types to there being a distribution as long as there is a positive mass of positive capital guys, and then some other mass, 1 minus alpha, of guys that are anywhere between 0 and 1. But importantly, this changes the individual marginal part of capital relative to this potential marginal part of capital in the economy. And that means that the firm that rents the capital from the high quality guys is going to pay them more than the one from the low quality guys. Moreover, and this connecting to the previous presentation, there could also be an ex post depreciation risk, which would appear like the investment risk in Sebastian's presentation. But again, the important thing for my paper is that this is going to be, and somewhat differently from what Sebastian's presented, is that there's going to be higher risk if you are of lower quality. That is, the variance of those risks is going to be 0 for the high quality guy, the Q equals 1, delta 1 is 0. But for all the low quality guys, you're going to face some idiosyncratic risk. So in the end, we end up with a model in which we have all these different qualities, and really one of them is just better. It's more productive on average, and it has no risk, whereas the lower quality are less productive and have higher risk. Okay. Now we alternate among these types, and depending on our type, we allocate our assets to bonds, private credit market, and the capital stock, where the key condition is this one. The key constraint driving the results is this one, which is that the amount that you are able to borrow, and negative L is borrowing, and therefore you promise to repay, has to be less than equal than a share of the expected return that you get. Okay. Yes, than the expected return that you get. And so likewise, it's smaller if you're a low quality person. Okay. Then private credit is private bonds are an inside bond, whereas an inside asset, whereas the government bonds are supplied by the government. And then there's a government budget constraint, which I wrote here in steady state form. And I'm going to look for, given different of these fiscal policy rules, looking at the equilibrium where this is true. That's the whole model, basically. To be clear about what's going on, if there were no credit frictions, the equilibrium is very simple. Everyone who's low quality lends to the high quality guy. High quality guy realizes all the returns, pays those returns to the other guys through competition. Everyone earns M in the economy. That's it. This is an AK economy. R is M. That's bigger than G. However, with a gamma less than 1 and a gamma, actually it has to be less than 1 minus alpha, but anyway, a gamma low enough, you're going to have that sometimes I'm the low quality guy. I'd like to lend to the high quality guy, but I can't. There's this credit constraint such that if I try lend too much, he's going to run away with it. Because of that, I would like, though, to store value for when I become the high quality. I need to find some other store of value. And that store of value is provided by the public debt. And that's what drives the gap M minus R to arise. Secondly, because not only secondly, likewise, because again, I could not lend all my capital to the high quality guy and I'm a low quality guy operating, I'm going to bear this idiosyncratic risk. And there, I'm then going to want to, on top of that risk, hold at least a little bit of public debt in my portfolio because it has a safe return that allows me to diversify some of this idiosyncratic return. And again, the gap M minus R is going to be driven by that. What does this imply? Let me start with a model where the simple case where there were just two types, 1 and 0, and neglect the ex post appreciation risk. So let me just focus on the heterogeneity ex ante, and then I'll introduce the ex post to the slide. Well, the solution to this model is relatively simple. It's relatively simple because basically alpha of the agents invest in the capital stock, the high quality guys. They earn the leverage return of M minus R, and this is how much leverage they can get from the other ones. And that determines the growth rate of the economy, which when combined with a government budget constraint must be paying for the deficit and the subjective discount rate. What that implies is that for a certain amount of spending, it must be that there's a certain interest rate that sustains that. The more you spend, the lower the interest rate on government bonds is. Why? So that the M minus R term is bigger and you have a bigger debt revenue term. However, as you spend more and need more debt revenue term, that higher debt revenue comes with a lower demand for the debt because there's also a market clearing condition for the debt that says that 1 minus alpha of guys hold the debt, the low quality, alpha hold the capital, and the more the low quality guys can borrow, the less public debt they want to hold. Therefore, what you have is that as you spend more, you're going to hit a point, which I'm going to call the fiscal capacity, at which simply there is no equilibrium with positive debt. And what that implies is that the value of the debt, which was falling as you were spending more and more, that value of debt hits 0, and you no longer can sustain the equilibrium with the debt revenue term. The debt revenue term collapses to 0. Okay. More spending requires higher lower borrow premium, lowers the debt. Note that this fiscal capacity has a simple expression, and it's higher, and this is perhaps the more interesting insight from this model, the better our private credit markets, the less the fiscal capacity. Why? Because the public debt here, all it's doing is providing me an alternative to the private credit markets. So if the private credit markets get better, then there's less fiscal capacity for the government because the service of the debt is lower. Likewise, if there's more inequality in this economy, in the sense that the lower quality, there's more lower quality guys trying to lend, then likewise, because of the limits of the private credit market, the more debt revenue term there will be and the more fiscal capacity there will be. What happens if you then introduce idiosyncratic risk in the general model? Essentially similar, but now there's an extra term, an extra demand generated by the fact that it's diversification, but the results, for the sake of time, are all the same, with the only difference that, and this connecting to Sebastian's presentation, that if there's more idiosyncratic in the economy, that increases what he called the bubble term, that increases that revenue term, because there's more demand for the public debt, which therefore relaxes the budget constraint, but otherwise the same. Now, this model, everything jumped, which was why it was an AK model. I only needed to solve for the steady state, which is what I did here. That doesn't have transitions. 3 extensions in the paper. What if I have a different fiscal rule? Not savings as a function of assets, but rather bonds, but actually the spending being a function of assets. Then you still end up with the same result as proposition 1, but now you end up with some interesting transition dynamics where if you spend too much, instead of exploding, you just go to a range where you leave the R less than G, and at some point R is bigger than G, and the debt revenue term disappears. If you have a neoclassical production function instead of 8K, again, you have some convergence dynamics. And finally, with the foreign demand, you end up with a debt revenue term that, again, has some convergence to it. But in the interest of time, just to say that it's very bang, this model, but I don't think that that's a particular, well, adding other things adds more other interesting effects, but I think keeps the basic intuition. More interesting, perhaps, is the following 4 policy results or propositions. First, imagine that I had a share of the debt, only a share of the debt actually pays a return to bondholders. The other debt, which I'm going to call the coerced debt, pays 0 return. Why do anyone hold it? Because you're coerced to do it. That's why I call it the coerced debt. Okay? Trivial proposition. Hey, if you force people to hold debt that pays below market returns, you're going to have more fiscal capacity. Why do I note that? Because I think that it illustrates well that some of the debt revenue term can be just a very familiar repression term, okay? But at the same time, that this is not a goal in itself. Having repressed debt in this economy unambiguously lowers growth, worsens the allocation of capital, and yet it increases the debt revenue because you're basically repressing the economy, taxing the agents. 2, imagine that you added some aggregate risk to inflation, which therefore would mean that now a positive inflation shock lowers the real value of the debt. Well, then sure, a positive shock to inflation is great because it lowers the value of your debt. But a higher variance of inflation lowers the fiscal capacity. Why? Because it shrinks the M minus R term. Why? Because the debt is now less safe, and therefore its safety premium falls. Interestingly, note that this means that in this economy, price stability and independent inflation target central bank is actually what maximizes fiscal capacity. Even though there may be a temptation to inflate the debt, that would make the fiscal authority worse off. There's no monetary fiscal conflict here because you're undermining the safety, what creates a debt revenue term in the first place. Third, what happens if you redistribute? So the way I'm going to do it here, just to isolate redistribution, is I'm going to go to the assets of the high quality guys, take some of it and give it to the low quality guys. Well, turns out that if you do that, you lower capacity. Why? Because when you do that, what that means is that now these guys want to use more of the private credit markets to give the money back to the high quality guys to operate. This ends up being akin to an improvement in the private credit markets. But this leads to this interesting prediction that if I have a policymaker who likes spending, let's arbitrarily call it the R party, likes spending in military or other things, and then I have another party, I don't know, let's call it the D party, who likes to redistribute, you're going to have a big conflict between them. Because the more one redistributes, the less space there is in the budget constraint to spend on stuff. And you then get a nice connection here to the old work by Alberto Alesine and Guido Tabellini and Torsten Persson, that if we have more polarization, we end up with more sovereign debt crisis. Why? Because you have more spending while there was lower fiscal capacity. And so a quite different interpretation of that old empirical work. Finally, fourthly, that if we have proportional, i.e. distortionary income taxes, and note, in my economy, there's only capital income. So income taxes, capital income taxes, I can't really talk about a distinction here. A cut in the tax rate may actually increase fiscal space. Why? Because even though it lowers revenues, because it allows for an improvement in the allocation of the private credit markets, it can improve the allocation of capital and boost the fiscal capacity. That says that to measure if a tax cut pays for itself, whereas the literature is traditionally measure the impact this has on labor supply or the impact this has on investment directly, this says that let's measure something else. What is the impact of a tax cut on M minus R, on the debt revenue term, on this premium? That is another source for tax cuts to potentially pay for themselves. One that potentially could be high, could be low, but at least coming out of this model. So, and I don't know, I'm probably early because Hanno has said nothing, or I've either done an amazing job or I was way too fast. Let me conclude.
A little early, yeah, but that's okay.
Okay, so let me conclude. I asked in this paper, what is the constraint on public debt when there is a bubble, R less than G, but the economy is dynamically efficient, M bigger than G, to use two names that have often been used for these circumstances. And I try to make 3 points. First, there is a debt revenue term. There is this other term. It turns out that in this paper, I found that using the language of this term was very useful to understand exactly when were budget constraints being relaxed or not. And I would argue, as I have in this recent survey, that it's also another very useful way to think about a bunch of different papers in this literature. That does not mean that there isn't a limit to fiscal capacity. It does mean, though, that there's different trade-offs and different things we want to measure when we discuss debt sustainability. Second point, I had one model of this debt revenue term. The key in this, and there's others, like you will see in the session, we're going to have 3 different models of what drives different forms of this debt revenue term in some ways. What was special about this model, or what I thought was interesting, or what I think is my small marginal contribution to the papers here, is this was a model that was all about substitutability between private credit and public credit. And that kind of, I don't know, from those policy predictions, I thought that was kind of insightful in that I get all these weird policy predictions, and they all become very obvious when to understand what makes the private credit market substitute for the public credit market or not. Whereas, for instance, Sebastian, it was a very different intuition of what's driving their bubble and mining term. For me, it's just really about that substitution that's driving everything. And then, as I said, once you get that, you get kind of surprising things, like you don't want to inflate the debt. Redistribution versus spending turn out to be a trade-off. You can pay for itself, but it has nothing to do with the labor supply. So you end up with very different takes just from thinking about this margin of substitution as highlighted by that. Thank you. Sorry, I probably spoke too fast, but oh
well. Thanks a lot, Ricardo. That was super clear. And I should note that it's almost 10 p.m. in London, but you're still very energetic even at this late hour. If there are no questions, I don't see any questions right now. If you have a question, please raise your hand or use the Q&A feature. And if there are no questions, then what we'll do, Ludwig has a question. So Ludwig,
if I may, I just shoot a quick question. So yeah, thanks a lot for the nice presentation, Ricardo. Why is M the right discount rate? That's something that keeps confusing me. Like, imagine a world where R doesn't change, so the government still runs the same fiscal policy as before. Now imagine the risk premium goes up for some reason. And so on the left-hand side, the debt level is sort of unchanged. But now if we use M, we sort of discount with a higher interest rate, and that sort of mechanically, I guess, increases the bubble term or debt revenue term and reduces the other, but sort of the debt level is unchanged. Why M? Why not something else?
Well, because it's about the substitutability, right? So the reason why, so you're right in the way in which the first term goes down and the second one goes up. On why the first term goes down, actually, that's literally the next paper on why in an economy with more risk, and depending on how that risk co-varies with a surplus, I think this is what Zhengyang is going to explain to us why that shrinks intuitively. But focusing more on the second term and why that goes up, well, because in that world with bigger risk, Ludwig, the debt hasn't changed, it's equally safe, but the alternative debt is riskier, right? The risk premium has gone up. So now the opportunity cost of holding debt for the agent is lower. If they hold the same amount of debt, B, then indeed the government is now earning a higher flow revenue in the sense of this opportunity cost. Of course, when the risk premium change, even if M minus R has gone up, maybe the amount of debt, B, that the agents are willing to hold, and thus my emphasis on the market value of that, because for an amount of face value, the market value may have changed, maybe that their revenue term has actually shrunk. So it's actually not clear that it's actually gone up. But if the market value would be unchanged, it would be simply because of that. I keep on valuing this debt the same way, even though now this alternative that's paying me a much bigger premium, this is now giving the government a bigger revenue term. But thank you.
Great. Okay. So thanks a lot, Ricardo. That was great. Let's move on to the next paper on the program. Zhengyang Jiang is presenting manufacturing risk-free government debt. Zhengyang, you got 25 minutes. All right, we can see your slides, so you're good to go.
Sounds good. Thanks, Hanno. Thanks for having our paper in this great program too. To me, this is really the most exciting question in macro right now. So this paper's title is Manufacturing Risk-Free Government Debt. It's joint work with Hanno Lustig from Stanford, Stijn van Nieuwerburgh from Columbia, and Mindy Xiaolan from UT Austin. So in this paper, we are motivated by a central question in finance, which is about how to manufacture safe assets. People have argued that risky assets are abundant and they naturally exist, whereas the safe assets are scarce and manufacturing them requires a lot of financial engineering. It's also been argued that governments are the natural issuers of safe assets because they're big, so anything they issue could be liquid, and they're powerful, they could tax to generate revenue, and it's been argued that presumably they can print money when it's necessary to pay back the debt. In this paper, we are going to push back these arguments a little bit by noting that the government's ability to issue safe debt is not a free lunch. In particular, we highlight that governments actually face a trade-off between manufacturing safe liabilities versus insuring the taxpayers. So let me begin by explaining what we mean by the taxpayer insurance. We start with the following observations. First, if we look at the federal government tax revenues, this is the amount of money the US government charges from taxpayers. We'll quickly notice that the tax to GDP ratio is highly procyclical. Whenever we go into a recession, the tax to GDP ratio will go down. And we interpret this as an insurance that the government gives to the taxpayers because the amount of money they have to pay goes down when we are in a bad aggregate state. On top of that, our second fact is that when we look at the federal government spending, excluding interest service, we'll see that this quantity relative to the GDP is highly counter-cyclical. Whenever we go into a recession, the spending to GDP ratio is going to shoot up. And this is exemplified by the most recent COVID crisis in 2020. So if we add those two things together, we will have a very pro-cyclical primary government surplus, which is defined as the difference between the tax revenue and the government spending. To the extent that the taxpayers are also the recipients of this domestic government spending, then we think about this as a double insurance that the government gives to the domestic agents. When we are in a bad state, tax goes down and they receive more government spending. Now, if we confront these results, these facts, to the debt discussion, we'll notice that these two sides are actually connected. On the one hand, as we have seen in this program, the government provides safe debt, which is an insurance to the bondholders. On the other hand, as we saw in those facts, the government also has pro-cyclical surpluses, which we argue provide insurance to domestic taxpayers. And we note in this paper that these two sides are connected by the government budget condition. And in particular, taking a finance approach, we can regard the government debt as liability, and we can regard the government surpluses as the cash flows. And as a result, there is going to be a joint trade-off between the extent to which the government can insure both parties. Now, to flesh out this trade-off, let us do with some numbers and algebra. We start with a general government balance sheet representation. In particular, let's consider the one period government constraint. On the left-hand side, we have the outstanding amount of government debt. This is DT minus 1 in market value. And we have the gross return to this debt. This is RD of T. Their product is the amount of debt the government owes in the beginning of period T, today. On the right-hand side, we have two options for the government to honor this debt. The first option is the difference between tax and spending. So this is a budget surplus, which the government can use to retire the debt. And the second term is the issuance of new debt. So the government can also issue new debt to pay back the outstanding debt. In reality, the government usually uses a mixture of the two options to honor the old debt. And when we have a budget deficit, that means tax is below spending, then the government has to issue a lot more new debt to honor both the old debt and to pay for this existing budget deficit. In our paper, we show that this relation can hold with great generality, including heterogeneous types of debt in both the maturity dimension and the risk dimension. In particular, we consider defaultable debt as a representative case. So under this setting, we can iterate this equation forward and show an intertemporal version of the budget constraint under the assumption of no arbitrage and no bubbles. We show that the debt valuation from the market has to be equal to the present value of taxes discounted by a pricing kernel M minus the present value of current and future government spending discounted by the same SDF. For simplicity, we use the terms PT and PG to denote these two present values. Now, these remind us of a corporate balance sheet, and this is why we write down this following theme as the government balance sheet. On the asset side, we have the tax claim. This is a claim to the cash flows representing today's and future government tax revenues. This is the amount of revenues that the government would collect. And then on the liability side, we have two things. The first one is the claim to current and future spending. And the second one is the outstanding debt. Both of these items are government liabilities. And what we just show in this intertemporal constraint is basically the balance sheet identity if we view things in this corporate finance way. We can further do more of the corporate finance and introduce Modigliani-Miller. To recall, the Modigliani-Miller theorem for corporate finance states that the systematic risk of unlevered corporate asset denoted by beta of the asset A is going to be the sum, a weighted sum of the systematic risk for corporate debt and the systematic risk for corporate equity. Using the same approach, we can show a similar Modigliani-Miller type of result for government finance. In particular, the systematic risk of tax revenue is going to be a weighted sum of the beta for government debt and the beta for government spending, where the betas are denoted and defined in the standard sense by the covariance between the negative SDF and the common dividend return of these claims divided by the variance of the SDFs. So this is our key result that combines the cyclicality of the tax and spending strips versus the cyclicality of the debt return. In particular, when we teach at Modigliani-Miller to a corporate finance context, we say that this result would fail when the debt is defaultable for a company. Here we show that our result, this government finance version of MM, would actually hold when debt is defaultable. And the intuition is that in the corporate setting, we usually assume the asset is an exogenous object. It doesn't change with default conditions. But here, our tax revenue does endogenously react to the default through the intertemporal government budget condition. So this result will actually hold with defaultable debt. So with this result, let us do a few simple cases to further interpret. Let us consider a special case where to keep the bondholders insured, the government decide to have exactly 0 beta for the debt return. This is our benchmark case that we define as a risk-free debt. In this condition, then we obtain a simple and stark restriction on the tax policy for a given spending beta. In particular, the beta for the tax claim is going to be a fraction of the beta for the spending claim. When we have a positive amount of debt, which is true in the reality, we will then have the result that the tax beta has to be lower than the spending beta. What this means is that now with countercyclical government spending, in other words, with low but positive betas for spending, we will need an even lower beta for the tax claim in order to keep the debt risk-free. And the low beta here for tax means that the government has to increase tax in bad times, which means much less insurance to taxpayers. Conversely, if we now care about the taxpayers and want to insure the taxpayers by lowering tax in bad times, then we have to accept a higher debt beta. And as a result, this renders the debt to be risky. So this is a key trade-off between making debt risky versus allowing the tax to be countercyclical, which increases welfare for taxpayers. What we do in the paper is to first illustrate what we mean by these two groups of people, the taxpayers and the debt holders, in a context which allows a segmentation of the two parties. This is the part that I will skip. And after we did this, then we present a few more cases with more specific settings to further illustrate what we mean by this trade-off. For the interest of limited time, I'm going to skip this literature review, but I just want to note that this literature has been informed by a lot of us who are sitting in this room. Okay, so for my next point, I'm going to embed this general result in a benchmark economy. It's going to be much simpler than the ones we've seen in this program. In this economy, I am going to consider only a permanent and IID shocks to GDP growth. So delta Y, where Y is the log GDP, is going to be determined by a constant growth plus an IID shock scaled by parameter sigma. On top of this benchmark economy setting, we're going to introduce the government who only issues one period risk-free debt. We think about this as a useful benchmark. And then for now, we're going to assume that this government commits to a constant debt to GDP ratio and also a constant spending to GDP ratio so that we can talk about the tax and surplus dynamics. We're going to relax these assumptions later, but again, this serves as our very first benchmark. With these assumptions, we show that the implied dynamics for tax and surplus are such that both the tax rate and the surplus output ratio are countercyclical. So whenever we have a negative shock to the GDP, the tax to GDP ratio has to go up and the surplus to GDP ratio has to go up. In other words, when we consider this very simple but stark case, the risk-free debt implies no scope for insuring the taxpayers. To do more asset pricing, in this model, we also bring in a standard preference and standard pricing kernel. In this pricing kernel, we use the same shock to the GDP epsilon, and we use this parameter gamma to denote the risk price. This, in some loose sense, measures how risk-averse the agents are. With this pricing kernel, we can now obtain pricing results and these betas for different claims. In particular, echoing the general result that I showed earlier, here we can show that the beta for the tax claim has to be lower than the beta of the spending claim, again highlighting the constraint on the tax cyclicality once we allow for risk-free debt. More precisely, also echoing the earlier result, the tax claim has to be very countercyclical, which means the tax rate has to go up in bad times. Moreover, here we notice that the debt to GDP ratio, D, is in the denominator of this factor. This suggests that whenever we have a higher debt to GDP ratio, this trade-off between tax and debt is going to be even steeper, meaning that for the fixed amount of beta for spending, we now have to manufacture an even more countercyclical tax process in order to make the debt risk-free. So with a higher debt amount outstanding, we're going to face this even bigger or more intense problem. Within this example, I also want to highlight a very interesting special case, which is R lower than G, the risk-free rate being lower than the growth rate. This echoes the title of our program today. This is a low interest rate environment. So in this low interest rate environment, our transversality condition can be expressed as the risk-free rate plus a risk premium term, which is the gamma, the risk price, times the volatility of the GDP, minus a Jensen second order term. If this left-hand side is greater than the growth rate, then it is still possible to satisfy the transversality condition and generate well-defined and finite valuation for all the claims considered. This is a basic asset pricing intuition. Whenever we have positive risk premium on these claims, then even when the risk-free rate is lower than growth rate, we'll still have bounded valuation. This is an interesting case here because in this case, the government can sustain a permanent deficit on average. So unconditionally speaking, the average surplus this government has is negative. It can run a lower tax than spending on average for each period. However, this is not a free lunch, because in this model, the beta constraint, our key trade-off, will still have to be satisfied. In other words, to manufacture risk-free debt, the tax claim still has to be countercyclical. We interpret this result as the following. We think now we can think about the government as earning an insurance premium in exchange for providing risk-free debt, and as a result, raising taxes in bad times. If we think about another asset pricing example, my favorite one is that the government is now selling some kind of auto money put on behalf of taxpayers. So on average, unconditionally speaking, the government runs a positive profit, which is why it could run a permanent deficit. But the price to pay is that whenever we hit a negative GDP shock, this is a recession time when the marginal utility is high. Now the taxpayers have to pay back by suffering a higher tax rate. Now, this risk-based view of the low interest rate environment is, as I argued, very different from the original Blanchard 2020 interpretation. In fact, we want to go one step further and say that in our model, it is precisely the positive covariance between marginal utility and government surpluses that creates the fiscal capacity to produce the risk-free debt. On the other hand, the condition R lower than G is neither necessary or sufficient to gauge this fiscal capacity in the risk dimension. I think I have probably 9 minutes left. So next, let me go over a bunch more numerical examples that help further illustrate different points in our model. The next thing I'm going to do is to relax this prior model. In particular, we don't like the assumption that debt to GDP ratio is constant. In doing so, we also want to introduce some new tool to deal with this trade-off now at different horizons. In other words, we think there is also a time dimension to the trade-off that we study. Our approach is motivated by our observation that the debt returns beta can be expressed as the covariance between the SDF and the innovation to the present value of discounted surpluses, normalized by negative debt times the variance of the SDF. In particular, this summation is from time 1 to infinity. Now we change this definition slightly and use this to denote a different object that we call the cash flow beta. We define the cash flow beta for surplus for a given horizon edge as this covariance, but the horizon is only from time 1 to a fixed maturity edge. This describes the cyclicality of discounted government surpluses up to horizon edge. And this has a desirable property that as edge increases to infinity, the cash flow beta goes to converge to the debt return beta, which, for example, we can set as 0 in our benchmark case. We likewise define the cash flow beta for tax and spending by replacing the cash flow for surplus by the tax or spending respectively, and they are related just by this simple difference relation. Now we're in a position to think about this time dimension of the trade-off. First, to get some working knowledge of this kind of approach, let me return to the constant debt to GDP case. In this case, as this red curve shows, the cash flow beta for the surplus is always negative across all horizons. In other case, no matter which horizon we look at for the next few years or quarters of surpluses, it has to always be countercyclical with respect to the aggregate shock to the SDF. So in no horizon do we have a meaningful insurance to the taxpayers. This result changes when we consider a more flexible dynamics for the debt to GDP ratio. In particular, we consider and calibrate an AR2 dynamics. We estimate this based on the observed debt to GDP ratio. So we want to have a realistic process for this ratio. Now, under this ratio, under this AR2 process, I should say, we now plot the surplus cash flow beta in red. And here, notice that this is a cumulative surplus cash flow beta. So for the first 2 periods, we have a positive beta for the first cash flow, and this goes up for the next 2 periods. In other words, in the first 3 years, we can have a temporary insurance to the taxpayers under the calibrated AR2 debt to GDP process. So when we have this more flexible process, we do have a very short-term insurance to the taxpayers. In other words, when we have a bad shock in the next 3 years, the government can still manage to run a small surplus to help, a lower tax to help these taxpayers. However, this red curve starts to decline and become negative, which means that after the 3-year horizon, most immediately, then now it's time to pay back. The future government surpluses have to be a lot more countercyclical in order to make the debt risk-free and respect the intertemporal government budget condition. So this is our result to characterize the debt to GDP ratio and the insurance across the time horizon. Another interesting result from our analysis is that as we increase the horizon, the risk premium for tax and spending have to basically be positive and converge to a constant slope. This is because in our model, tax, spending, and GDP are co-integrated. So in the super long run, they must inherit the same positive risk premium that we assign to the GDP. This is a key feature in our environment of the permanent shock, permanent GDP shock, I should say. Now, having done so, the question is whether we can consider more variations of our model such that the government can get away with the trade-off. We consider several different cases. And for example, we consider a case in which we have transitory shocks to the GDP and to the utility. In that world, to our surprise, the trade-off actually becomes tighter. And that's something we leave in the paper. The other salient case, as been mentioned in earlier papers in this program, is the case with convenience yields. By convenience yields, we mean a very standard and specific thing in the literature. If we consider the debt return as being evaluated by this standing investor with pricing kernel M, having a convenience yield here means that the investors require a lower than fair compensation to hold these convenience assets. And fair here is determined by this pricing kernel. In other words, if we look at this Euler equation, on the right-hand side, we have a wedge term. When kappa is positive, this whole term is going to be smaller than 1, implying a lower than fair compensation required to hold these convenience assets. We don't further microfund this, but we note that also in our own work and others' work, that this convenience yield is quantitatively important with implications for both exchange rates and currency union dynamics. With this convenience yield term being defined this way, we can further define the seigniorage term, which Ricardo called as a debt revenue term. Here, this is the amount of debt issuance revenue that the government earns because of the convenience yield. If the debt does not earn the convenience yield, then the debt price is going to be lower, so the government raises less revenue from the issuance of new debt. So this gap is exactly measured as the new revenue source because of the convenience yield. We go back to our original result and show that in this case, the debt valuation is now equal to the value of the tax claim minus the value of spending claim plus the value of this additional seigniorage claim. Then to consider the seigniorage terms contribution to the trade-off, we go back to the picture we make. So let me explain this, and this will be the last key result that I present. Here, to have a simple case, we consider a fixed convenience yield, but the debt to GDP ratio is going to go up further when we are hitting a recession. As a result, the seigniorage revenue overall is going to go up, which allows the government to temporarily have an insurance on behalf of the taxpayers. This manifests itself in this spike and going up pattern for the taxpayers trade-off. However, in the long run, as the convenience yield is stationary and the debt quantity is co-integrated with GDP, again, the long-term risk premium on the seigniorage revenue term has to be equal to the risk premium on GDP, which is positive. So this claim will become a risky claim if we look at the super long-run cumulative dynamics. So our conclusion from this exercise is that convenience yield, especially a countercyclical convenience yield, is going to provide a short-run relief to the trade-off which allows the government to insure the taxpayers in the short run. However, this could worsen the trade-off in the longer run due to this co-integration and risk premium effect on the seniority revenue claim. With that, I think I'm almost out of time, so let me conclude. In this paper, we study the trade-off between government's capacity to manufacture safe or risk-free assets versus the government's commitment to insure domestic taxpayers. We find that there's a very tight constraint between the government's capacity to do both and countercyclical and persistent debt issuance, and the countercyclical convenience yield could both help push out this trade-off, but only temporarily. With that, I think our simple lesson to learn here is that the risk-free government debt is not a free lunch, but requires a tremendous amount of financial engineering that pays attention to this trade-off. Thank you.
Okay, thanks, Zhengyang. Right on time. Let's see if there are any questions, if anybody puts their hand up. If not, what we can do is move to the last paper on the program, which I think is going to be presented by Ludwig. Is that right, Ludwig? Are you presenting?
Yep, I'll be presenting.
Okay, great. So Ludwig Straub, Ludwig, you can share your screen, is going to present a Goldilocks theory of fiscal deficits. You have the floor.
Great. Well, thanks very much for speeding up so that I have 40 minutes to present. I'm just kidding. But great. Well, thanks very much for inviting us to participate in this August session. This is joint work with Atif and Amir, who are both on the Zoom call. Great. So the questions that our paper asks, let's see if I can actually switch slides. There we go. Are the following. First, we want to understand what the joint dynamics are of debt and deficits. And second, and very much related, what are the fiscal costs of higher debt? Now, there's a standard logic out there that if you increase the deficit today, that pushes up the debt level, and that requires that the deficit later on be reduced. And that's sort of the fiscal cost of having a higher debt level. Now, some recent work by most prominently Olivier Blanchard has shown that, with R less than G, you may never have to reduce the deficit in the future. And so increasing deficits today can be a bit of a free lunch. However, there's no general condition on whether R less than G is sufficient for this or not. So what we want to do in this paper is we want to show first that a free lunch is possible in a general deterministic model if R is less than G minus phi, where phi is the sensitivity of R minus G to the debt level. So it's a stricter condition that R less than G. R less than G is not sufficient for a free lunch. We also have an extension to aggregate risk, which I'm just going to flash, but I'd be happy to tell you more about it afterwards. Second, we're going to argue that the standard logic may flip entirely at the ZLB. In fact, at the ZLB, it can be the case that low deficits increase the debt level. Now, why is that? Because low deficits mean low aggregate demand, which means smaller inflation, which means weaker nominal growth, and that can increase the debt level. Third, we argue that the role of inequality is actually somewhat ambiguous. It generally increases fiscal space, and that echoes a result that Ricardo already talked about. But at the ZLB, we find that it can actually reduce it because it reduces aggregate demand and hence inflation and hence weakens nominal growth. Now we do a calibration to the US and Japan pre-COVID. And we argue that back then, the US was barely in the free lunch region. And Japan, on the contrary, was squarely in the free lunch region. Now, I'm going to use a tractable model based on convenience yields today, but we have a bunch of robustness in the paper, and it might even flash a figure at the end of the presentation that argues that even though our model is all about convenience yields, you can take a general model such as a perpetual youth type model that Sebastian presented and get very, very similar effects to the ones that we're going to talk about. Now, there's a very exciting literature that we learned a bunch from including a lot of people here on the call. I'm not going to go through more of that today. Okay, great. I'm going to start with the framework that will include a ZLB constraint, but then for the second part, I'm going to take out the ZLB and analyze just free lunch and fiscal space without a ZLB. And then we're going to throw in back the ZLB and see what changes with the ZLB. And then we're going to do the quantification or calibration exercise. Great. So what is this framework? We're going to try to be as simple as possible, given that we're the last on the call and everybody has having Zoom fatigue. So this is a deterministic endowment economy with rationing at the ZLB. There's three agents here. There's a government that issues government debt. The government spends and taxes as well. On the household side, we have spenders and savers. So savers here will have a preference for convenience benefits embodied in government debt. And third, there's going to be a monetary authority, and we assume that that authority implements the natural allocation whenever that is possible, meaning everywhere above the ZLB, we're going to be sort of in the natural allocation, a real economy, but at the ZLB, that's where you can have rationing. Now, in terms of notation, that's a slightly different from notation before. So let me emphasize how we use R and G. So capital R for us is the net nominal interest rate. The reason we pick the uppercase letter is because it's a nominal object. Capital G is the net nominal growth rate. It's a sum of productivity growth and inflation. R star is the natural interest rate that always achieves the inflation target in all periods. And G star is the nominal trend growth rate. That will be the nominal growth rate outside of the ZLB region. Now we're going to jump straight to the detrended version of the model, in which case potential output is a constant, which we're going to normalize to 1. And R minus G, in some sense, becomes sort of the detrended interest rate that will always appear wherever you were used to seeing an interest rate. So let me talk about the household side for a second. So we have spenders and savers on the household side. Savers make up fraction 1 minus mu of all households. They're going to maximize a discounted stream of utility, which comes in every instant from utility over consumption and utility from holding government debt. Okay, so this V of B, sort of this convenience utility function that captures, convenience benefits that the agent associates with government debt. And B here for the entire presentation will be government debt relative to a potential GDP. Now the budget constraint is quite standard. We have consumption, we have saving on the left-hand side. We have the detrended return, so to speak, on government debt. On the right-hand side, we have the saver's share of overall income, 1 minus mu times Y, and we have lump sum taxes paid to the government. Now, spenders, we assume, don't pay any taxes, and they just consume their share of income, mu Y. And finally, what is Y? We model Y as just a labor endowment, which is always equal to 1 outside the ZLB, but at the ZLB, it may be rationed to something less than 1 if there's sort of insufficient aggregate demand. Great. Now, what does the government do? We assume that government has a fixed amount of government spending X, and then it chooses taxes tau and government debt to always satisfy its budget constraint. Now, the object that we're going to play around mostly with here is the primary deficit. We're going to call that Z. And so by changing tax rates, the government can influence the path of the primary deficit. Now, as I said, we are assuming monetary dominance, meaning whenever we're not at the ZLB, you can think that the central bank follows sort of an active Taylor rule that always ensures that R is equal to R star at all times. And at the ZLB, that won't be possible. In that case, R is just equal to 0. Now, at the ZLB, because there will be a shortfall of aggregate demand, what will happen is that wages are going to be downwardly rigid. They're going to be prevented from falling. And so that will mean that now output will adjust rather than wages. So we're going to have rationing in output. Y will fall below potential, below 1. And inflation will also fall to some extent, but not all the way, to some extent, in response to that shortfall in demand. And that, how much it falls is given by the simple Phillips curve relationship. Okay. This just tells us the greater the output gap is, the bigger 1 minus Y is at the ZLB, the more wage, disinflation you're going to have at the ZLB. Okay, so this is a very standard way of modeling the ZLB. Great. Now, everything I told you about this ELB, we're going to put on a pause for a second, and we're going to think about an economy that does not have a ZLP constraint. And this is, you can think of almost just a real economy where we don't need to think about the ZLP at all. I'm going to start by analyzing steady state equilibrium. Okay, so what do I mean by that? For every level of government debt relative to GDP, there's going to be a steady state that exists for a suitably chosen deficit Z that is chosen to keep government debt constant at that level. Now, what is that Z? To figure out what that Z is, let me rewrite the government budget constraint as follows, just as a law of motion for government debt. And you see that Z shows up here on the right-hand side. And by just setting B dot to 0, I can figure out what kind of primary deficit I need in order to stabilize government debt at B. Okay. And so, simple algebra tells you that that's equal to, that deficit is equal to the gap between the growth rate and the interest rate times the debt. Now, what are these objects? What are G and what are R? What is R and what is G? G, because we're at potential outside the ZLB, is just equal to the trend growth rate, as I mentioned before. The only really endogenous object here is the interest rate, is R star. And to figure out what R star is, we just write down our beloved Euler equation. So that relates consumption growth to the gap between the detrended interest rate, R minus G, and the discount rate. So far, everything is completely standard. And the new term here that comes in due to the convenience yield is just that there is this additional term in the Euler equation that effectively makes agents a bit more patient, especially when debt is low, when they really want to have debt, when there's a high convenience yield associated with government debt. If our already agents, or the saver in this case, is holding a lot of government debt, that marginal convenience utility will be relatively small. And so in that case, that won't make the agent so much more patient. Now, solving for R star, we get a very simple equation for R star as a function of the steady state level of government debt. It's just going to be a constant minus the convenience yield term. If that convenience yield term is large, then that means R star will be low. If that convenience yield term is low, then R star will be large. Now, a very simple way to represent this is in the following diagram. So on the horizontal axis, we have government debt relative to GDP. On a vertical, I'm just showing you the nominal rate and the nominal growth rate. Now, as I said, outside the ZLB, the nominal growth rate will be dead flat. There's no change there, but the nominal interest rate will be increasing, precisely because as you have higher debt levels in this particular model, you're going to have smaller convenience benefits. Now, if I want to figure out what the deficit is that is associated with a given steady state level of government debt, I can simply use these two curves and compute for every level of debt what this Z is, meaning what the gap between G and R is times the debt level. And if I do that, I end up with a very simple diagram that we're going to call the deficit debt diagram. It's going to have deficit on the y-axis rather than these interest rates, and still debt on the x-axis. And so you see that this deficit, that primary deficit that you run in a steady state with a given level of government debt is sort of naturally hump-shaped. Now, why is it hump-shaped? Well, it's 0 here because debt is 0. And it's 0 there because that's where R is exactly equal to G. That's where the two sort of intersect. And in between, it's going to be positive, in line with the idea that when R is less than G, the government can sort of run a positive primary deficit forever. Now, this locus is our way of thinking about fiscal space. So it's a very sort of flow budget constraint kind of way, but I think it's actually quite intuitive and quite useful. Now, this is all steady states. Now, let me argue that this is also a relevant diagram for transitions. Now, why look at transitions? Let me motivate this by pointing to this common view out there that when R is less than G, that the debt that government debt is stable. Now, why is this a common view that some people might have? Well, if you write down the law of motion for debt, let's look on the right-hand side of that ODE, you see that the coefficient on government debt is R minus G. And so if R is less than G, you may think, oh, great, that means debt is stable. And that means you have ample opportunity for running a free lunch policy. Okay, so for example, you could increase the deficit forever and debt will not explode. You can increase the deficit temporarily and debt will especially not explode. In fact, it will go back to the original level if you do that. So a lot of opportunities for a free lunch if this ODE is indeed stable, and you may think that that's the case when R is less than G. Now, this is not true in our economy. And the reason it's not true is because R is a function of government debt. And so this ODE won't be stable just when that coefficient is negative. In fact, what you need to look at is the derivative of the entire right-hand side rather than just thinking of this coefficient. And this entire derivative can be positive, indicating instability, even if R is less than G. And so what the right condition for a free lunch policy, for a stability of this ODE turns out to be is it's a stricter condition than R less than G. It's R less than G minus phi, where phi captures the increase in the interest rate, or the increase in R minus G in general, in response to an increased debt level. And that is a crucial object that sort of tells you, if you borrow $1 more, that this is the increase in sort of inframarginal cost of debt that you have to take into account if you borrow $1 more. Now, we don't have much to say on welfare, but let me just point out that in our model, a free lunch is always a Pareto improvement. And we have a version of this result that even works with aggregate risk. And the result then takes the following form, that the probability of being able to run a free lunch policy where debt does not explode, you can pick that to be arbitrarily close to 1 when R is less than G minus phi, minus an additional correction for aggregate risk that scales with the amount of aggregate risk. And so it's a bit tighter, but in numerical simulations, we haven't found that sort of additional term to be all that large. Now, what's kind of neat is that this free lunch idea can actually make sense in terms of our deficit debt diagram. Okay. And to go there, let me just add arrows, sort of in a very face diagrammy 1980s type of way. I'm just going to add arrows to this diagram and explain to you what these mean. So these arrows tell you what happens when you deviate from the steady state locus. So for example, imagine this is where I start. This is my economy. Now I increase the deficit. Now what these arrows tell you, and it's kind of natural, that if you increase the deficit, you go over to the left. And very much in the spirit of the standard logic here, at some point, because you can't go off to infinity forever, you can't have debt explode, that would violate the transversality condition. You have to correct for that increase in debt at some point with a reduction in the deficit, crucially one that is below the original deficit you started with. And so the standard budget constraint kind of logic applies in this region here, where this locus is downward sloping. But if instead you start over here on the left, you can be in a case where if you increase the deficit, you actually do not go all the way to infinity. You run into the locus before you go into infinity, so you converge to a new steady state without going off to infinity. That does not explode, even if the deficit is higher eternally. And that's exactly what a free lunch looks like in our diagram. And so if I collect all the points where a free lunch policy exists, it will be all the points to the left of this line, to the left of the sort of peak level of the primary deficit. And this is exactly the area where R is less than G minus phi. And notice how there's a big difference between R less than G minus phi, which is to the left of this line, and R less than G, which is over here. In fact, if you ask me, there's nothing special happening here. It's downward sloping all the way. There's no break or anything. For us, the key sort of separating factor that tells us whether there's a free lunch or not is R less than G minus phi, not R less than G. Now, let me make just a very, very small remark on present value budget constraints, because I think there's sort of an interesting perspective our model adds to this. So for us, what the what one potential interest rate is to discount this equation by is the marginal rate of borrowing that the government faces. And notice that this is not just R less than G, it's actually R minus G plus phi, which includes this inframarginal term that I talked about before. And if you sort of linearize around a steady state that has this object be positive, which could be right over here, it could be a point where R is less than G. But still, sort of the margin rate of borrowing can still be positive because R can be bigger than G minus phi. And in that case, you actually end up with a well-defined government, present value government budget constraint that, you can see that there's some benefits of this, debt being special. So there's sort of something that looks like the debt revenue term that Ricardo emphasized. And there's also discounting with an interest rate that, could potentially be much smaller than say the marginal product of capital. But it's interesting that, this is a well-defined, present value budget constraint, even if you sort of discount it with the marginal rate of borrowing rather than the marginal product of capital. Now, let me just do one simple comparative static here. One thing that we were particularly interested in is what happens with respect to changes in inequality in terms of this locus. We do more comparative statics in our paper. And so what happens if you increase inequality in this model is that you expand this deficit debt locus, meaning you expand fiscal space. For every level of debt, now you can run a bigger primary deficit forever. And the reason is quite intuitive because savers, rich savers are the ones that buy government debt here. And so if more resources go to savers, they have more money to buy government debt, and that makes it cheaper for the government to finance itself, lowers the interest rate, and that expands fiscal space. And I'm not going to repeat this point, but we have a similar point here on sort of how this can be potentially a conflict between sort of the R party and the D party in the government. Great. Now I'm going to reintroduce the ZLB. So this was all without CLB. Now let's take it one notch more complicated. Let's add the ZLB. Now, when will the ZLB bind? Well, naturally will bind when R star, the natural interest rate, is negative, because that is unattainable by the central bank in our model. Now, R will be 0, but instead what will become endogenous now, which used to be exogenous before, is output. And in fact, output will now be demand determined, will be generally below potential, smaller than 1. And consumption here will still be determined by the Euler equation. So we can still write down the Euler equation just like before, except that now R will be 0 and G, which used to be exogenous, now becomes endogenous. Now, why does G become endogenous? And it's absolutely important here to keep in mind that G is a nominal growth rate. So technological growth is not changing in our model. So this is different from the models that Sebastian and Ricardo present. For us, the only thing that changes at the ZLB is that inflation changes. Inflation will fall short of its target. Think of Japan, for example, when there's less demand, and that will mean the nominal growth rate will change. And so if you solve the system of equations, you're going to get that R0 naturally at the ZLB, but now G was endogenous because inflation will fall short of its target. So what does this look like in our diagram? So this is, again, the diagram that had the interest rate and the growth rate. And to the left of the point where the ZLB becomes binding, to the right of the point, everything is just like before. Okay, we have an increasing R, we have a flat G. But now notice what happens at the ZLB in this region over here. You have that now, instead of this gap, widening, we have that it narrows instead. Why does it narrow? So quite the opposite, because the nominal growth rate now, the more I push you into the ZLB, the more the nominal growth rate will fall, because inflation will fall more short of its target. And the interest rate will stop falling in that region because you hit the ZLB. So this is why this narrows. And quite naturally, this narrowing gap will imply that there is less fiscal space at the ZLB, because now the gap just has shrunk in this region. And this will be stronger the more G starts falling as we move into the ZLB region, meaning the steeper the Phillips curve is, the more inflation starts falling short of its target. And so if I plot the deficit that is required sort of in a steady state for debt to be stable, it will no longer have sort of this shape that I showed you before. Instead, you will have that with the ZLB, that it sort of eats in a little bit to the deficit debt locus that I showed you before. It reduces the deficit that you can run at the ZLB. And in fact, if I make the Phillips curve steeper, you're going to see that this will actually start falling steeper and steeper. And in fact, if you make the Phillips curve sufficiently steep, this can even be backward bending. Now, this may seem weird, but let me explain the intuition. And I'm hoping that I can convince you that that is actually quite a natural outcome that can happen. So what happens in this case where it's backward bending? Let me focus on a given level of debt. Imagine this is the level of debt you have as an economy. Now, if I have deficits that are up here, we already know the natural thing happens, debt increases because you're running a huge party. You're having a huge deficit. But now let's imagine we have deficits down here. Now, if the deficit is that low, think of Japan. Imagine Japan now massively increases taxation in a very regressive way, let's say. Well, that would almost certainly reduce aggregate demand. And in fact, they tried to do something like this because they tried to increase the value-added tax in the 2000s. And that also is a regressive tax rate that reduced demand. And if demand is reduced here by running a very low or a deficit or even a surplus, then that hits the nominal growth rate. And remember that the nominal growth rate, if it's lower, means that all else equal, the debt level will want to rise more relative to what it would have done with a higher nominal growth rate. And that's part of the reason why with a high nominal growth rate right now, the debt level is coming down again in the US, for example. So this is the flip side of that. So with very low deficits or surpluses, you also move to the right, but because the nominal growth rate starts to become really weak. And so only in this intermediate region here do we have that debt levels are stable or even falling in this intermediate regions of deficits. And that's why this paper was called Goldilocks zone. So at long last, now here's the reason for the title. Great. Now, what happens to our comparative statics? Let me just highlight what happens when you increase inequality with a potentially binding ZLB. Again, you see that fiscal space expands outside the ZLB, but now at the ZLB, because greater inequality in our model reduces aggregate demand, it can sort of weaken the nominal growth rate and make fiscal space contract at the ZLB. I should point out, though, that the free lunch region always expands with greater inequality. So you can always sort of make your way out of that ZLB with sort of a free lunch type policy in a higher inequality environment. Perfect. Let me use the last few minutes I have to talk about a calibration of our model. And we're going to do two calibrations here, one to the US and one to Japan. Now, as you might think, as you might already anticipate, the key object that we need to calibrate here is the shape of the convenience yield function, given that determines how fast, for example, you run out of fiscal space as you increase the debt level. Now, how do we do that? So the first thing we have to do is we have to make some functional form assumptions of what shape that fiscal convenience yield might take. We use functional forms that come from the literature that try to estimate these convenience yield benefits. The shape that I've put down there, and we analyze others in the paper, is a simple linear functional form assumption, where the key parameter here is the slope at which the convenience yield declines as you increase the debt level. And that slope is exactly the phi that shows up in our R less than G minus phi condition. Now, what is this phi? So we survey the empirical literature in the paper. We even have our own mini contribution on this topic. And overall, we find phi estimates between 1.2% and 2.2%. And if you think about the usual estimates for the gap between G and R that you see in the data, 1.2 to 2.2% is a lot. This is not nothing. And we use the midpoint for this, but I'm going to show robustness to these other estimates later on as well. And we calibrate the remaining parameters to match sort of a pre-COVID steady state for Japan and for the US. So what are the deficit debt diagrams that we find for these two economies? So on the left, you see the US pre-COVID. And the dot indicates where we sort of calibrated the US to have been before the COVID. And this is a steady state for the US. Debt was around 100% relative to GDP. And you see that according to the calibration, we were actually very close to the edge of the free lunch region. So not a lot of fiscal space that you don't have to pay back according to this calibration. I don't want to take a stance on what's going to happen post-COVID, but if we go even just close, if we go even back to something close to this, schedule, we're going to be way past the free lunch region. Now, for Japan, things are more interesting. Japan was at the ZLB back then, and in fact, according to our calibration, it's still at the ZLB, but according to our calibration, they were in sort of the backward bending part of this diagram. And so this suggests that Japan is actually in a situation where if they increase the deficit, that might actually marginally reduce the debt level rather than increase the debt level like it would in the US, for example. It also indicates that Japan is in the free lunch region in that they can increase their deficit without even, having to, pay for it, increase without even increasing the debt. Finally, let me take a step back all the way to the intro where I mentioned that this was, a model with convenience yield, but you could analyze, other models through the same lens as we do in the paper, as we do in this, for the main part of our analysis. We have a bunch of other models analyzed in the appendix of our paper. So for example, we have Ricardo's model in there. We have a model with idiosyncratic risk that has some of the flavors of Sebastian's second model. And we have a sort of risky steady state analysis of the Blanchard model. And across all of them, they sort of look relatively similar for the US. We haven't done an analysis for Japan, but my guess is you'd get relatively similar plots. Great, let me conclude. So I started by giving you the standard logic as sort of a straw man that, oh yeah, higher deficits always lead to explosive debt unless deficits are cut eventually. So what our paper suggests is that this is may not be entirely true. We showed that there can be a free lunch if R is less than G minus phi, in which case increased deficits, at least modestly increased deficit, may not lead to an explosion in debt levels. Second, I showed that when the ZLB is binding, debt may not even rise at all if you increase deficits. But that requires some assumptions, and certainly not true for the US according to our 2019 calibration, but maybe true for Japan actually. And third, I showed you that inequality has interesting implications for fiscal space, generally increases fiscal space, but at the ZLB, it might sort of reduce fiscal space. Thanks very much for having us.
Great. Thanks a lot, Ludwig. That was super clear. Let's see if there are any questions. I had a quick question about aggregate risk. So you introduced the aggregate risk, and the term you had was proportional to sigma squared. But in asset pricing, typically you'd expect to see a sigma term. Do you have a quick intuition for why there's just the standard deviation of risk, but just the variance, but not the standard deviation? Because that's what makes it small, presumably, right?
Yeah. I have to look at 3 pages of math probably. My sense is that it's similar to why sigma squared shows up if you write down sort of a standard, consumption asset pricing model where you have, like the model that Zhengyang presented.
But there's a sigma term. That's why I'm asking, right? There's like a gamma sigma term, right, Zhengyang? Or is it so late that I thought
it was sigma squared, but maybe I'm misremembering.
There's both.
It wasn't gamma price and risk.
Yeah, so there's gamma times sigma, and then there's a sigma squared sort of Jensen's term, if I'm not mistaken.
But gamma was the price of risk, right? In a general equilibrium model, that would be proportional to risk itself, and then you get sigma squared.
No. Gamma is like no gamma.
Was it not a sharp ratio?
You're muted.
Okay, maybe that is Zhengyang. What do you think?
No, I think I agree with you. I think maybe we should have a longer discussion, but I think what Hanno had in mind is 2 terms. One, proxying for the risk price for aggregate risk, which is something we both agree on. And the other thing, which is interesting term, is the Jensen's inequality term, which arises from a log normal distribution when you take the expectation, for example.
Yeah, but right. So that is something maybe we can discuss a bit more offline. Be interesting to see, to reconcile the
Yeah, exactly.
expressions we have with the ones you have. But yeah,
it's the youngest member of our slides, so it would be nice to bring it together with the things you guys have done.
Super. All right, thanks, Ludwig. Thanks, everyone. That, I guess, ends this session, unless there are any other questions. I think people are probably...
Sebastian, I think, has a question.
I have more comment, and so I would have had a question about optimality, but you answered it already. I think your debt deficit diagram and our alpha curve are basically the same thing, but with the x in steady state, but with the x-axis flipped. So your free lunch region is, in a sense, the inefficient region of our alpha curve, where you can increase your debt and at the same time reduce the bubble mining. So I think there's this mapping between the two models.
Yeah, I tried to flesh that out in our appendix. So it'd be super nice to correspond a bit more on this, because
yeah, sure, absolutely.
Because we're always thinking about sort of the dynamics and how sort of debt evolves. And I think for you, because the price level jumps, debt can jump. And I'd be super interested in sort of figuring out exactly what sort of the analog of our diagram is for your economy. So if you can touch base on that, that would be super, super good.
So ultimately, we look for the steady state. It doesn't matter what can jump and what not. It's just for the transition dynamics that matters.
Exactly. And we're thinking about the transitions, and I'd love to sort of hear your thoughts on what would happen in your model if you because I think everything would jump, but we can
exactly
offline.
That's one reason why we do it that way, because it makes things
exactly.
Great. Well, thanks for participating, everyone. I certainly learned a lot from seeing all these papers presented one after the other. I hope you did too. And yeah, let me end by wishing you all a happy new year and hope to see you soon in person. Take care. Bye.
Thanks, Hanno.
Thanks, everyone.
Thank you. Bye.
Bye.
Thank you.